Oh, hello. I didn't see you there. Welcome, guys. I got an awesome one for you guys today. In fact, this is probably my favorite video that I've done to date so far, so make sure you pay attention. One of the things that you hear about on financial media, on the internet, this thing is in my way, on the internet, on Jim Cramer, on Bloomberg, all those things, when stocks are going down, is people are buying protection as a means to mitigate the losses if stocks go down. Now, I don't know if any of you tried it, but I have, and I certainly have my opinion on it. So what we want to figure out is, we don't just want to listen to what they say on financial media. We don't just want to listen to what everyone is saying. We want to go in there and we actually want to dig through the numbers. So what we did in this video, and you're going to learn here in a second, is what we're going to go ahead and do is we're going to go ahead and we're going to figure out if buying puts as a means to protecting your portfolio is a profitable strategy or not. And if it is, exactly the right time to do it. Now, this is kind of a cool one. I'm really excited about this because, again, this is something that you guys have heard of before. This is something that has been talked about in financial media, but no one has actually taken the 10 minutes to go in there, do a back study like I did to figure out if it is the right thing to do. So what we're going to do is we're going to go talk about what it is, and then we're going to go do a study during the financial crisis of 2008 to seeing if buying puts was the right thing to do in that time. So strap on, guys. It's going to be an awesome one. I'm super excited. I'll see you guys back inside the computer. We are back. We are inside the computer, and now we're going to get into it. Now we're going to talk about and answer the question, does buying puts to protect our investments work? Now, again, this is what you've heard before. When they talk about portfolio protection, investment protection, 99 times out of 100, and the only reason I'm not saying 100 times out of 100 because nothing's impossible, but 99 times out of 100, the recommendation to protect a portfolio is the purchase of put options. We're going to get into if that works, if it does, why does it work, if it doesn't, why it doesn't work, and we're really going to get into it and vet it out. Remember, guys, we don't just take what others say and just automatically do it because some rich person said to do it or some big-time investor said to do it. In other videos, we have taken exactly what the top 1% of investors are doing, the Warren Buffetts of the world, and kind of debunked what they were saying. Now, those same investors recommend, as a means to protect the portfolio, the buying of put options. Let's see if that actually works. Let's see if it's the right thing to do here. And again, guys, on the left, just so everyone knows, if you never see me talk at a conference, if you never see me in person, never seen any of my videos, like, this is the best I've ever looked in my entire life. My skin is glowing, my hair is super thick, big smile. I don't look like that. The lady who did these photos must have photoshopped them. But anyway, let's dig into it. Does buying puts to protect our investments actually work? I'm super excited about this one. So again, guys, let's take it a step further, or a step back first. Buying puts. Their puts are a form of an option contract, right? An option contract is just an agreement to buy or sell 100 shares of stock for every option contract at a predetermined price at a predetermined date. So puts are a form of an option contract that when purchased benefit from a drop in the prices of an underlying stock. So I'm going to go into the trading portfolio now, and I'm going to SPY. SPY is the S&P 500 Index ETF, and we're going into the options chain. We see calls on the left and puts on the right. We will see a benefit in the price of the puts if we buy puts and the price of the stock goes down. So I'm going over to the 265 put expiring in 5 days, and I'm going to click on the ask. The reason I'm going to click on the ask is the lowest amount that someone is willing to sell for, right? And since we want to buy, there has to be a seller at the same time. So we're going to go ahead and we click on the ask, and we have bought or analyzed buying an actual put. So if you see here, we said puts are a form of an option contract that when purchased benefit from a drop in the prices of an underlying stock. We have simulated here a 5% drop in the stock, and we see we make about $1,100 by purchasing this put. So that's what a put is. And they could be seen as a way of reducing losses if a stock goes down, because the value of the put will increase as the value of the stock decreases. So let's simulate buying 100 shares of SPY and at the same time buying a put. If we just buy 100 shares of SPY and SPY goes down 5%, we lose about $1,300. But if we go ahead and buy SPY and at the same time we're going to go ahead and buy a put, you can see we go from losing $1,333 to only losing about $263. The reason for that is because the value of the put will increase as the value of the stock decreases. And as you can see, as the stock goes down more and more and more and more, the value of our loss doesn't even get any greater because, again, the value of the put will increase as the value of the stock decreases. So this is why people recommend buying puts as a way to reduce losses when stocks go down. It's because they typically trade 1-for-1 at a certain point. We can see here again, guys, if we just buy stock and the stock goes down 5%, we lose about $1,300. But if we buy stock and we go ahead and buy the put, if the stock goes down 5%, we only lose about $263. But if the stock goes down 50%, we only lose $267. So it's about the same. Again, that's the way you can quote-unquote limit your downside based off of buying puts as a way to protect your investments. And for this reason, obviously, investors purchase puts in order to protect their downside and know that their downside is limited. Now, when do we want to buy these puts as a way to, mitigate our losses, as a way to protect our downside? Well, the price of options, which include put options, remember there's calls and puts, they are inflated when the VIX goes up and are reduced as the VIX goes down. Now, we're not going to get into what the VIX is here. I will put a link below in the description of this video. We created a video about what the VIX actually is. Again, it's not what you think it is. So if you want to get into what the VIX actually is, I'll put a link below in the description. You can go ahead and go wild. It should be pretty eye-opening to all of you. But as the VIX goes up, the price of puts go up. As the VIX go down, the price of puts go down, and the same thing for calls. Right? So logically, if we benefit, when we buy puts, if we benefit from the price of the put going up, we would like to purchase it when the VIX is down. So logically, this means we would want to buy puts when the VIX is low so that they can increase proportionally to the amount the stock goes down when prices sell off and the VIX rises. However, the concept of buying puts when the VIX is down typically does not happen. And again, I'll link to a video where we talk about that as well. We talk about both these things, right? The hope is that the puts we purchase will prevent us from major losses when the market has a major sell-off. Who would not want to protect themselves from major losses when the market goes down? I know I would. Hell, I know I'd love to do that. Now, in order to figure this out, the example we used right here is awesome, is great. Remember, if the S&P 500 were to go down, not 50%, 5%, just by buying 100 shares of stock outright, we would lose about $1,333. However, if we bought a protective put to protect our downside, a 5% drawdown in the S&P 500 would result in only a $263 loss, so $1,000 less by buying puts. Now, that's a really great example. However, does it really work when put into practice? Does it really work live? So we went ahead and we did a study to figure this out. Now, if you're new to this channel, you'll notice that a lot of our videos, a lot of our content has to do with pure numbers. So we like to remove emotion, we like to remove other people's opinion out of what we think, and we like to just inject studies, and then based off those studies, make trades, make investments, execute on strategies with the confidence that the numbers support what we're doing. So what we did is we did a study from 2005 to 2010. So the reason we did these years is because 2008, the end of 2007, all of 2008, and the beginning of 2009 was a horrific financial meltdown. A horrific financial meltdown. Horrific. In theory, buying puts should be its most profitable in that time. It only makes sense because remember, financial meltdown, stocks went down about 50%. Again, we profit from buying puts if stocks go down. So we want to see, in the best case scenario, was buying puts a good idea? So this is why we did 2005 to 2010. So that's 5 years of data. And what we did was we did this in SPY. So SPY is the index ETF for the S&P 500. It is the most liquid product in the world, and the numbers for these studies are really easy to get. So what we did was every month we purchased one put 5% below the current price of the stock. So right now, the price of the stock is $265.51, and we would go ahead and purchase the 252, or if they have a 252.5, they do put. In this case, for about 46 cents. And we did that every single month for those 5 years, and we did it in the monthly expiration cycle closest to 30 days from expiring. So right now, this would not be the monthly expiration cycle. Right now, the closest monthly expiration cycle to 30 days would be these right here, the January 19th. So let's go find the 252.5 put here. In this case, it's going to be the 253. We're going to go ahead and buy it for about 72 cents. So that is what we did for those 5 years. And then we held the put until it expired. And we calculated the P&L from the protected put we purchased. Now, the goal would be to have the P&L from the puts make money, right? Because if they make money, that would be a way we would know for sure that we would have benefited from buying puts as opposed to just owning the stock outright, right? And we have every expectation in the world, that this would work. Remember, 2008 was a massive financial crisis. It was really, really nasty. So this should be overwhelmingly positive to the camp of buying puts. So let's see what it looked like. And here are the results. Again, remember, 2005, 2006, 2007, 2008, 2009. Let's take a look at what that actually looked like here. Let's go to the charts. SPY 2005 to the beginning of 2010. So this is what we were looking at right here. For the first couple years, 2005, 2006, and even 2007, we have every expectation that this would not be a profitable strategy as stocks went up. However, in 2008, we would expect to see a massive profit in terms of buying protection as a way to really mitigate some sort of downside risk. Let's see what that ended up looking like. So every single year, buying puts 5% below the price of the stock, whether the stock went up like it did in 2005, 6, and 7, or down drastically like it did in 2008, did not work. It did not work. In 2005, 6, and 7, there was not one put that expired profitable. In 2008 and 2009, there were puts that did expire profitable. However, the losses were greater than the wins. Again, we're talking about 2008. We're talking about a 50% loss in stocks. A 50% loss in stocks. Yet, no money is made buying puts. Yet, no extra money was saved from our long stock positions buying puts. None. Absolutely none. That is some crazy stuff. While we did have some big winners. In 2008, we had a $624 winner. Remember, this is on one contract. In 2009, we have a $528 winner. However, over the course of the year in 2008, we were still a loser. In 2009, we were still a loser. Does buying puts to protect our investments work? No. It does not work. At least when we think about buying puts once a month, 5% away from the price of the stock, and doing it in the worst financial crisis since 1987. It does not work. The numbers do not support it. Remember, this is what we're looking for. 5% below for 30 days. That's it. We're doing it again in horrible financial conditions. Horrible financial conditions. It still does not work. It still does not work. Yes, that's right. It is better to just not buy puts at all. Even in the worst of financial conditions, 2008, it would have been better, and you would have lost less money because you didn't make any money if you were long stock. You would have lost less money just owning the stock and never buying puts. Now, there's a few reasons why this is the case. You know, what's the catch? In order for a protective put to be profitable, the price of the stock must be below the price of the put plus the price paid for the put. So in our example of buying one put 5% below, this put is not profitable until it gets below 253 plus the amount we pay for the put. So in this case, it would have to be below 252.28 for it to be profitable. Because we are paying a credit, we are paying a debit, we're actually paying money for this. So it adds to it. If the stock were to, if the stock, when this put expires, were to be at 253 on the dot, the value of this put would be 0. Thus, we would have lost the full 72 cents on buying the put, and we would have lost the full $1,333 on buying stock. Again, because buying puts makes you at even a greater disadvantage, because not only do you have to get down to the strike price, or in this case, you have to get down to 253, but you have to get beyond the strike price by the amount that you pay in debit for the put. So that widens out and makes it less likely that you will reach that point. Right? So this increases the price. The stock needs to go down because, again, the stock needs to go down to the price of the put plus the price paid for the put. So if we go back to what it looked like back in really bad financial conditions, so let's go to 2008. March of 2008 was really, really bad. Let's go 04. Let's go to SPY. March of 2008 was very, very bad. If we went to these monthly expiration cycles and we said, okay, the price of stock was 133 times 0.95, the 126 put. The 126 put is $2.35. So not only would the price of SPY have to go down 5%, but it would have to go down another $2.35 just to break even, just to start making 1 penny on the put. And that's why buying protective puts as a means to protect your downside does not work. It's because you are paying a debit for those puts. So not only does the price of the stock have to go below the price of the put, but it also has to go below the price of the put plus the price paid for the put. So what are some of the takeaways? Buying puts as a means of protecting the downside of long stock positions, even in terrible financial conditions. Terrible financial conditions. Terrible. Does not work. It does not work. They do not turn a profit and do not reduce losses. In fact, they increase losses. That's right, they increase losses. Buying puts during the financial crisis increased losses. It did not decrease losses at all. So, buying puts as a means to protect the downside of a stock position does not do what it was intended to do and only adds to losses and does not prevent them. Guys, this is a really, really big deal. Do not buy puts as a way to protect your downside. Do not do it. It won't work now, and it didn't work in the worst financial conditions of our generation. Now that should have been pretty eye-opening to you guys. Remember, probably for your whole investing career, you have heard buy puts as a way to mitigate downside. Buy puts as a way to protect your long stock investments. But when we dig through the numbers, and when we go back to horrible financial conditions, which was the financial crisis, the credit crisis of 2008, it did not work. If it doesn't work in the worst financial conditions, it's not going to work in average financial conditions, or even okay financial conditions, or good financial conditions. Buying puts as a means to protect your downside does not work. They only add to losses. They don't ever increase losses. You might get a one-hit wonder where one put all of a sudden makes a lot of money, but over the long run, right, over a full year, they do not work, guys. Do not buy puts as a means to mitigate losses. Do not buy puts as a way to limit your downside. They only add to your downside. Thank you guys for tuning in. If you have any questions, hit me up in the comments below. I'll see you guys in the next video.